All right. Are we live, Joan?
We are live. Hello, everyone. Welcome as you're pouring into this webinar today. Good to see you all.
Fantastic.
Great. They're popping in. Oh, we've got a really large number of participants here today. Actually, we reached our maximum numbers. So we had to cut off our registrations early for this. So as everyone's coming in, we'll just hold off until everyone's in the room, as everyone's popping in. Maybe we do a quick introduction for each of us first as everyone's pouring in. What do you think, Simon?
Yeah, fantastic. Well, why don't you kick off, Joe?
Brilliant. Okay, wonderful. Well, welcome on board. Of course, you're here today with Breaking Up with Your Business Partner. My name's Joanna Oakey. I'm the Managing Director of Aspect Legal, and we are specialist commercial solicitors. We also have a couple of podcasts that you should check out if you haven't heard them yet. The Deal Room podcast, which is one of the top podcasts in Australia for SMEs dealing with business sales and acquisitions, and Talking Law, which is all about smart legal tips for business. So you can find both of those on your favorite podcast player. Simon and Nick, throwing over to both of you.
Fantastic. Well, Simon Bedard, I'm the founder and CEO of Exit Advisory Group. So we do fundamentally two things. We help business owners actually buy and sell companies, and we do this every day. So we got a very, very good understanding of what drives value in a business. And really the other part of our business is advisory work. You know, what's your business worth today? What is evaluation? How do you go about that? What's your exit plan? What does that look like? How do you plan for this once in a lifetime kind of event and make sure that you maximize that? So that's us. Nick.
Hi guys, my name's Nick Fanto. I'm the Director of Orbital Advisory. I run a specialist life insurance advice business, and we've been in operation for 12 years. We work with individuals and business owners to make sure they've got adequate risk protection strategies. And we do a lot of work around key person and buy-sell insurance, which is going to be our big focus today from our angle.
Fantastic. And I guess anybody who's on this webinar today, I imagine most of you are here, you know, the topic, of course, is breaking up with your business partner. And of course, other sort of events that sort of really circulate around that topic. But I think if you're on this call, it's because you've either been in business with somebody, you're currently in business with somebody, or maybe even thinking about going into business with somebody. And perhaps you understand that that can come with a lot of positives and a lot of strengths, but also a lot of risks. And so I guess, you know, kicking things into gear here, I mean, it's an interesting topic because we all get into business for some reason, right? It's, you know, some people just because they're looking to create an income, they have an area specialty and they're looking to sort of be their own boss. Others get into business because they've got a grand plan to change the world. It's whatever your reason for being in business, you know, it's often a deeply personal thing. But of course, we get into business with other people and that can add an entirely new dynamic to things, right? You might want very, very different outcomes to your business partner and have very different concepts on where things should end. So I guess one of the big themes that we're going to be talking today about is you know, exiting really on your own terms, right? And exiting well and the importance of actually having some sort of discussion and plan around that, right? Yeah, I mean, you're going to want to get something out of this journey. You put a lot of time, effort, and money into it. So we know what is the ideal outcome. And of course, I guess today's topic is really addressing a lot of risk around this. And, you know, I think if you just simply define risk, it's the likelihood that you get an outcome different to what you're expecting, right? So, you know, you suddenly go into business with other people. Let's be honest, lots of things can happen in business, both from a personal relationship perspective, from a market perspective. I mean, we're coming out of a global pandemic. I think everybody kind of has a really good sense of what risk looks like these days, right? But I guess one of the big things that we see out there is, and it's quite tragic in a lot of ways, is this breakdown of business partner relationships, right? And this can happen for a whole bunch of reasons. And I guess really what we want to get to the guts today, and we'll talk about some of those scenarios about how those relationships can come apart. But really what we need to get to is how do we start to mitigate those risks so that people can protect themselves and ultimately get what they're looking, you know, for and achieve the goals they want on this journey we call business. So now, of course, one of the big things that we see in terms of risk mitigation, of course, is actually having some form of shareholders agreement. And it's sad to say that I think probably less than 10%, you know, and I haven't done a poll of every single client, but I'm guesstimating it about less than 10% of my clients and all the people I speak to actually have a shareholders agreement. And if they do...
Good news, Simon. We are actually going to have a poll in this webinar, so we'll be able to test that theory. But sorry, I completely agree with you.
Absolutely, yeah. So, you know, having actually some sort of sense around what you're doing, and you know what, you know, you spoke about polls, you know, if you're thinking or you understand this simple concept that we are all going to get out of our business one day, you know, you need to start thinking about, well, how much runway do you have to achieve what you want to do, right? So, and I think we actually have another poll question there, don't we, Joe, about, you know?
We do, absolutely, absolutely we do. And
shall we launch that? I think we're, you know, if you haven't thought about your exit, that's okay. If you've got a bit of an exit in mind, fantastic. But we've got a little poll question here just to get a bit of a sense of, you know, when you think you might want to exit your business. Now that might be just, you know, we're not talking about necessarily selling your company or anything like that. It's about getting out of the day-to-day, right? Not having to work in the business anymore. You might hold it as an asset. You might sell it. That's fine. We're not talking about the specific exit strategy. It's just more, where do you sit with the timing and have you thought about this? And so while you're doing that and looking at those questions, you know, as we're sort of talking about, one of the key things, I guess, that that we need to be addressing in terms of risk mitigation is understanding, you know, A, what you want to get out of it, B, what your partner or business partners might want to get out of this. And this all speaks to exit planning, but then having some way of actually not just documenting these objectives, but having a documented means for you to actually discuss this stuff and perhaps resolve any potential disagreements that you might end up having around the direction of the company and you know, ultimately your contributions as business owners. So that's probably a good segue to hand over to Joe. I mean, Joe, you know, you're dealing with this stuff every day, right?
Yeah, absolutely. Absolutely we are. And just before I get on to that, because I'd really like to talk about some examples, I think it's great to be able to share like real life examples of what ends up on our desk as lawyers. But I just wanted to talk about this poll because it's brilliant. We've had almost every attendee fill that in. I can see the 5 of you who haven't filled it in. No, I'm kidding. But there are a couple that haven't. So, so make sure you get in there. I'll end it in a couple of minutes, but it looks like here that we have the highest response, so that's 32% are looking to exit their business in 5 years or more. So, you know, down the track, 30% don't know. And I think that's super interesting, that concept that at least a third of the people who are on this webinar at the moment don't know when they might exit the business. And I think that's a true representation of business as a whole, isn't it? And that's why we're talking about this topic today. And it actually segues beautifully into some of the cases that I wanted to talk about, the examples that I see on my desk of problems that occur day in, day out, that we see business owners going through. And that's that you can't necessarily always anticipate when you might want to exit. And have you set yourself up in the right way to allow yourself for that exit into the future? Now, exit can mean one of 2 things. It can be you exiting the business or you wanting to exit one of the other shareholders, which is a common thing that can happen when there's disputes between owners, but also in this trend that we're really seeing at the moment of this move towards getting businesses wanting employees to become shareholders as part of their talent retention strategy and their succession planning strategy, and this whole idea that if you're bringing on employees or others as minority holders, what sort of control do you have at the end of the day if it doesn't work out the way you want? Now, I just had, I mean, I'm having discussions with business owners all the time at this initial stage of thinking about implementing these strategies, but also at the end when they have years ago implemented these strategies and now found out they'd not implemented it correctly. And what the common issue is in those sort of scenarios is, for example, an employee has been given shares or purchased shares, and then there comes a period of time where suddenly perhaps the parties work out this isn't working, and they need to be exited from the business. How do you get those shares back? And if you don't have a shareholders agreement setting that up, that can be a massive issue. So that's one of the issues that I have to say, we've got quite a few matters that are on our desk right at the moment. It's a really hot topic and hot issue at the moment. Another issue that we're seeing is shareholders getting to a point where they're just not agreeing on things. They get to this point where maybe things just aren't working between them. And often there's two particular problems that come out at this phase. Number one, it's the lack of provision in the shareholders agreement to deal with disputes. So this relates to controlling decision making within the business and how that happens. And the second component is, well, if you don't agree, how is it that you organise exit, whether you're the party that wants to exit, or as we talked about before in the case of the employees, how do you exit other staff or shareholders or equity holders? We've got an example right now on our desk of a business owner that was seeking to sell out of the business, but couldn't get the agreement of one of their other shareholders. And the problem is when that happens and you haven't got a shareholders agreement in the background to provide you with the ways to ensure that if you've got a group decision to exit or a majority decision to exit, then you're all on board to do that, then it can be very, very difficult to get, agreement between the parties if someone feels either A, they don't want to exit and they have the power to hold up the process, or B, they want to, I guess, create a situation that's more advantageous for themselves because they can see that they're less emotionally connected with this need to exit. So they're hanging in for a greater payday. And, I don't know, guys, have you seen this sort of situation before?
Yeah, I mean, that's interesting. I had another client as well. There were 3 founders, all equal shareholders. And interestingly, along the journey, two of the founders married each other. So talk about changing the dynamic, right?
Right, absolutely.
And these are all really super smart people, and they've done a lot of planning and prep, and they actually even had a shareholders agreement in place. But of course, the trap was that they hadn't sat down and discussed, what if one of us or more than one of us wants to actually get out and do their own thing. And literally, as this one client said to me, he goes, I would actually have to die so that my family can extract the capital we've got tied up in this business.
Yeah.
He said, and clearly that's not an ideal solution. So look, this sort of
stuff.
Well,
and we're definitely going to talk about
that. Indeed.
Well, sorry, I was going to say one that I found really interesting, Simon, and we've spoken about this before, were 2 clients of mine that their whole plan when they started the business was to transition it to their kids. And they were on the same page. They wanted to transition it to their kids. And one of the children ended up being unwell. He was diagnosed with cancer and he doesn't want to go into the family business. The other son wants to go into the family business, but the business partner cannot stand the son and does not want to be in business with him. So how do you communicate about that? How do you get on the same page? The ballpark's changed. And so it's not much of a conversation to have, hey, by the way, mate, I don't like your son.
You know what? It's a really important point you make, Nick, because the point is that putting in place things like shareholders agreements, thinking through exit, is helping you to go through checklists of asking questions that you may not otherwise ask, but that you should be asking and that you need to ask. And the role of a shareholders agreement, I guess, is to drive you into ask these questions. But really, it's to help guide. It does many things. I don't want to oversimplify it, but in essence, the 2 really important things that it does is it helps drive how decision-making is going to happen in a business and the expectation that you have between other equity holders, and secondly, how exit will occur. So we've got another poll for you. So the first thing the poll that we're going to launch right now, there we go as we speak. Do you have a shareholders agreement in place right now? And if you're an advisor and you don't want to answer this about your own business, then maybe reflect on how this might be answered from the majority of your client base. And so we've got some options there, a few yeses, but with caveats about when they're reviewed, because the point here is not just creating a shareholders agreement and having it in place. That's, of course, a critical thing. It's also about ensuring that you've actually signed it. Can I tell you the number of people that I've spoken to where they have the shareholders agreement, but they've never signed it? But it's also about ensuring that the shareholders agreement is reflecting where you are today in your business. And something that you signed 10 years ago isn't necessarily reflective of today. So, yeah, sorry, Simon, I feel like you want to throw in there. Go for it.
No, you're spot on, right? I mean, it's a living document, and if you're not reviewing it every sort of couple of years, like, you know, and it doesn't need to be this deep dive. Review it, do a check, pass the sanity test. Yes, it's still fit for purpose, you know. And if it's not, then great, you've got the precursor for a discussion without conflict, right?
Yeah.
Because, you know, at the end of the day, shareholders agreements are best written while you still like each other, right?
Oh, so true.
And especially when people start off in a business, right? There's this honeymoon phase of everyone's so excited. It's a great opportunity. Everyone sees the opportunity, and we're often blinded by the opportunity, and we're blinded to the risks.
Yeah.
And so, you know, whilst everybody's hugging it out and high-fiving about this new venture, let's sit down and have a really open conversation and transparent conversation about all the various things that could go wrong. And without it doesn't have to be a big negative discussion. It's just hey, look, you know, life happens, right? You know, nobody in December 2019 thought that we would be locked up for most of the year in 2020, right? So stuff happens. Let's just assume that stuff will continue to happen. How do we start to plan for that in the most appropriate way?
Oh, I love it. I love it. And thanks everyone for filling in this poll. There's just a few responses we're waiting on, but I just want to share the results because I think it's interesting, although not at all unexpected. But we have 40% who say no, they don't have a shareholders agreement. So that's pretty good, guys. You're, as a whole, you're probably higher than what we anecdotally see in the market. 10% say yes, it's in draft, but not signed. I think that's definitely something that we can all attest to having seen regularly. And can I just say, when clients come in and I ask them for their shareholders agreement, if there's an issue in the business or whatever, and they say, it's that moment when you can see them kick themselves saying, oh, you know, we had these discussions, we had it in draft form, we just didn't quite get there. 29%, so that's a third of all respondents, have said yes, we do have one, but it hasn't been reviewed in the last 2 years. And I think that's a critical reminder that you really need to be going back and ensuring that you're reviewing these things and ensuring that they're current. And we have 20%, so only 20% of the attendees who have one in place and have had it reviewed in the last 2 years. So kudos to you.
Well done.
Big claps, that's right. And Nick, I really want to dive into some of the topics that you're going to talk about today. I just want to leave with one thing. I think it's really important for you to understand that there's a number of clauses, clever clauses within a shareholders agreement that we can add that are super useful to deal with some of the issues that we've been speaking about. There's drag along clauses. There's, right to appointment to a board, which is funny because many people think they don't want to be a director, but they forget that they might want to retain a right to appointment to the board and lots of other things like this. But really, at the end of the day, it's about, number one, asking the questions together, having the discussion, number two, actually getting it in place and getting it signed. But Nick, what are some of the things that you see as issues arising in this area?
For sure. So I guess the big thing here is everybody's focused on building a business. We're going to build a great business, and potentially you've sat down with Joe and you've got a fantastic shareholders agreement and you've got a clear vision of where you're headed. But unfortunately, life doesn't always go to plan. And unfortunately, unforeseen circumstances arise. And I'm going to spin this in a positive light, and we're going to talk about death and disablement. So essentially...
Spin it in a positive light.
Yeah, exactly. We're going to talk about death and
Nick.
disablement. But, back to your point before about a shareholders agreement, we're talking about planned exits. Often there's planned exits. Where do we want the business to get to and what's the transition? But not all exits are planned. And that's where I step in. And there's two things I want to talk about today, which is key person risk and buy-sell insurance. People find this quite confusing. People often ring me up and say, hey, Nick, I want to buy a key person policy. I want to buy a buy-sell policy. The first thing to note is that key person and buy-sell insurance are not products. They're actually strategies. With life insurance, you've got three products. You've got life cover, you've got total permanent disablement cover, and you have trauma insurance. Key person and buy-sell are essentially strategies that use those products. So if we start with key person is essentially a policy that the business would own on the life of a key person. And that policy could be designed to replace a key staff member if something was to happen to them, to allow the business to keep functioning. It could be to repay debtors. It could be, you could have an investment into your business that you want to protect. Often we find, if you want to take out, say, a business loan or something like that, the lender will request that you have key person insurance in order for them to sign off on the loan. So you've got key person insurance, which actually protects the business. But what I think is more pertinent to this conversation around shareholders is actually buy-sell insurance. Now, a buy-sell agreement essentially sits within your shareholders agreement, and it talks about the exit of a shareholder. So in real simple terms, let's say that Simon and I have a business and the business is worth $1 million. What happens if Simon dies? If we don't have a shareholders agreement, who owns the business? I'm actually now in business. The likelihood is with Simon's wife. Simon's wife's a lovely person. Simon's wife may want to sell me her share in the business, and we might agree on the price. Who's to say I can actually get the finance I need? The bank's going to sit there and say, well, hang about, you want us to give you $500,000, $1 million to invest in a business that's just had a shareholder depart. Is that a good bet for us? And you're getting money at the moment, it's not easy. The other part of that may be that Shanti might be willing to sell the business, but she might have someone in her ear saying, you know what? It's not worth $1 million. It's actually worth $3 million. So if you want to buy me out, I want $1.5 million. And then I've got to sit there and go, well, hang about, I don't believe the business is worth that. And now we've got a massive problem because that business is actually my livelihood and I want the controlling stake. This is where buy-sell insurance comes in place. In my mind, the cleanest solution would be that Simon and I have a life insurance policy and a TPD insurance policy that is spoken about within the shareholders agreement that states that if Simon dies, we've agreed to the value of the business at X, and that insurance policy will pay his estate. And once his estate receives that money, we get the shares back. So essentially, insurance becomes the funding mechanism of the buy-sell agreement. It means we don't have to worry about, sorry, Simon?
No, Nick, I was just going to ask the question. So presumably there too, it's all based on a predetermined valuation methodology, right?
Correct. So what we do, there's really 3 steps when you're looking at buy-sell insurance. First step is we need a valuation. So what we've got to do is we've got to sit down likely with your accountant and understand what is the value of this business and how have we valued that business, because that sets precedent. The business is worth $2 million. Obviously, most business owners are trying to drive growth within their business. So we need a baseline methodology. So every year we can review the cover and review the value of the business to make sure, because what we don't want to do is, set up a policy based on a value of a business of $2 million. Then in 3 years' time go, well, it's actually now worth 6. And the insurance has just bought a deceased shareholder out of the business for $1 million. So it's really important that we get a baseline valuation for the business. And it's really important that we're reviewing that every year to make sure that, the insurance mirrors the value of the business. That's a really important part to it. The second part of it is making sure that you have the shareholders agreement done properly, because the insurance means nothing if you don't have the appropriate legals. Because essentially, if I go back to our scenario, Simon, if we don't have the legal agreement and you've passed away and your wife receives that insurance money, without the legal agreement, she's just received that insurance money. There's no legal agreement that's actually given me the shares back, which is inevitably what it's like. And again, you know, your estate might sit there and say, well, hang about, we've got $1 million, but we want another $1 million for the shares. You just don't know how people are going to react in a circumstance like that. So again, for me, buy-sell insurance is such a clean exit strategy. We need valuations. We need legal agreements. The insurance companies have changed. They've tightened up on providing this insurance. They're going to want to see a valuation, and they're going to want to read your legal agreement. But I think it's, when we're talking about shareholders agreement, it's a really clean exit strategy that just enables, you know, it's just going to basically enable the transition of shares without the need to sit down and discuss dividend payments or have arguments around what is the business actually worth. It's all predetermined. So it's definitely something that anyone in partnership should consider when looking at their shareholders agreement.
Well, and that rolls. Oh, sorry, Simon. I was just going to launch a poll and then let's hear what you were going to add in there. We've got a poll in here. I think that links in very well to the poll here. Does insure? Oh, hold on, I haven't launched it. How about that? Okay, off we go. Now it's launched, and everyone should be able to see that. We've got a bit of a delay in launching it, but anyway, it will pop up soon. As soon as it launches, I'll pop back in. Maybe as it's trying to launch. Simon, how about you? You let us know what you're about to say there.
Yeah, it was just a quick question, I guess, for Nick, because, you know, not everybody's in business with, like, their business partner is not necessarily an external person, right? Like, so some people are shareholders with their spouse, right? Yeah. And so, you know, I see a lot of people, and the question that was asked to me recently is, well, if I'm in business with my wife, then I don't really need a shareholders agreement because we've got other things in place. And I guess just my kick to both of you as both legal and insurance experts, but, you know, you might be in business with your spouse, but it doesn't mean you shouldn't have some insurance there as risk mitigation, because if you're both integral to the business, you know, lots of problems can happen. But I also imagine too, Joe, from a legal perspective as well, there are control elements, right? About, well, who can make decisions and who can do what?
Well, you know, and I'll let Nick answer most of it, because I think there's, you know, the insurance element is probably a fundamental part of your question. But just very quickly, I think it comes back to this concept of it's that checklist, isn't it? It's that forcing the regime of asking the questions that you wouldn't think to ask, or that maybe might be a bit uncomfortable to ask. And, you know, decision making in close context, that can be a really useful decision, you know, that can be a really useful discussion to have, super useful discussion. But also I do find that, so, and I think James, someone commented here on the chat, no shareholders agreement, but I'm sole owner currently, and totally, you know, I understand that position, but sometimes people forget when that moves, when that changes, then that's when they really need to kick in to think about some of these other areas. So, but I think.
Yeah, and no, sorry, I'm cutting across you there. I was just going to say, but and to that point, to that participant there, like if you're the sole shareholder, do you have dependents? Do you have kids? Do you have an estate? Are there people who would inherit things? That business is an asset, right? So you still need to know if something happened to you, what actually happens to this asset?
And that's where, you know, in that circumstance that you're discussing, Simon, and even for someone who's a sole shareholder in a business, buy-sell insurance isn't appropriate. Well, it could be, but it's unlikely. It's definitely not appropriate for a sole shareholder. We do see some strategies where, let's use my business as an example. I do see some advisors who may have an insurance business, and they may have a mate down the road who has an insurance business, and they actually sit there and go, my business, in my mind, has a beneficial value of X amount of dollars, but it's only worth what someone's willing to pay for it. So we do see people enter into agreements where they go, if I'm to pass away, there is an insurance policy that's going to pay out my estate, which is it's effectively allowing somebody else to buy that business. It's transitioning you your business to another business owner, which is actually quite an interesting strategy. The other thing I would say, Simon, to your point about, say, a husband and wife team, is buy-sell insurance, again, may not be relevant in that instance, but I think key person is, and that's really dependent on what the roles of the individual are within that business. And I'll give you an example of a business, a construction business that I do a bit of work with. And there's two directors, and they're actually brothers. But what you've got is one guy who, he's a builder. He basically designs the builds. He builds the houses. He runs all the construction guys, the construction element. But then you've got the other brother who runs the business. He's like the CEO. He sits there. He does the financials. He does the pricing. He runs the back office. Now you've got two very separate roles within that business. And this actually happened where the construction brother was unwell. He was diagnosed with cancer and he had to take about 8 to 9 months off work to get better. Now it's really hard to pitch for work when you don't have a builder, when you're in construction. So they had key person insurance and they had about $500,000 worth of cover. And what happened there was the policy paid $500,000 to the business, and that actually allowed them to pay their key staff, to basically pay their creditors, pay their rent, pay for their vehicles, et cetera, for that 8-9 month period where they were really hamstrung until the other brother was fit to come back to work. Because what you don't want to have happen is have this brother get unwell. He needs to take 8 months off work. We've spent 10 years building a great business, but now we're going to go under because we can't work. We can't bring income in, and you lose staff and you lose cars and you default, and it just becomes a bit of a nightmare. So I think to your point, Simon, it's a matter of understanding what the outcome needs to be and then tailoring the insurance to fit the outcome that you're trying to create. Every scenario is going to be different.
Yeah, absolutely. How are we going on the poll there, Jo?
Yeah, brilliant. We've got almost everyone voted now that we've finally been able to launch it. So if you haven't voted, please vote. But we've got more than 50% of people. So our question related to whether insurance forms a part of your business's succession or exit strategy. And more than half said no, they hadn't thought about it. They didn't even know this was an option. So I think that's really, really interesting. We've got 5% answering yes, but I'm not sure what we're covered for. And that's fascinating as well, that you can have insurance and maybe not entirely understand it. And that's like a shareholders agreement as well, though, isn't it? You know, and maybe you can talk to that point in a second, Nick. What do people get confused about? Because I think that's really important. But shareholders agreements are the same. Quite often we'll find that they're in place. When they're in place and haven't been reviewed for a while, people just don't understand what they actually say and what they're meant to do. You know, it's not meant to be a piece of paper that sits at the bottom of your, your file cabinet, not reflecting where you are today. So what about you, Nick, and maybe Simon as well? What's the things that people are most confused about in this area, do you think?
I just think people don't understand how their insurance policies work. And the differences between the policies. You know, I'll often have clients come to me because there's been a trigger event. It might be a friend has become unwell and it's made them go, wow, I really need to action something like this. And I sit down with so many people who go, yeah, I'm covered for that. And I go, oh, no, that's not what you're covered for. We're talking about trauma. That's TPD. They're different products. So I think people don't understand what they are covered for. The other thing that we're seeing at the moment is there's a lot of change. There's a lot of regulatory change in the world of insurance at the moment. There's premium instability. There's a lot of moving parts. And I had a client only a couple of weeks ago who came to me and said, Nick, I'm spending $8,000 a year on this stuff. It's just too expensive. And he gave me his policy documents. And I said to him, well, you're paying $8,000 in 2016. What are you paying now? He's now paying $28,000 for the same cover. He's just never looked at it. And I said, so if you're uncomfortable at $8,000, you're going to be really uncomfortable at $28,000. And it's just funny that, when the main driver of a lot of the referral work I get is people sitting there saying, I don't actually know what I've got and whether it's adequate or not. And, obviously the poll speaks to that, as it also speaks to the fact that people just don't understand what is available to you and how the insurance can actually work with your business. And if you insure your business adequately, that actually flows into your personal insurance. So it could be that your business can maybe, this is obviously dependent on the structure of the business, but often the business can be funding and protecting your family from something happened to you, which will enable your personal spend on insurance to reduce. So I think it's really important to understand, how's the policy structured? Is it tax effective? We see it with buy-sell agreements all the time, where the policies are actually structured in a way that capital gains tax is going to hit really, really hard. So there are ways that you can structure buy-sell insurance where the proceeds are tax-free. That's really important because obviously no one here, well, I can't imagine anyone listening in on this wants to pay more tax than we need to. So there are strategies in which to get it. You can never beat the tax man, but you can certainly work as best as you can.
Be smart about it. Absolutely.
Absolutely. We've had a lot of questions that came in as we had registrations for this webinar. And there were some phenomenal questions, actually, a whole heap of them. We've tried to answer quite a few of them so far, but we're just going to pull out a few that we think maybe haven't been answered and just run through some of those just to make sure we meet you where you are right at the moment. If you have more questions, throw them in the chat, and I can see there's a few there. We'll try and get to them and or put them in the question box as whichever way you want to do. We're watching both the Q&A box or the chat box, but we might go through a couple of the questions that were asked by at the registration phase. So Simon, what ones stood out in particular to you?
Yeah, look, and there was a couple of them that overlapped with a similar sort of theme. So, but really, I guess one of the key ones for me was a lot of people are asking, what do I do in the beginning? How do I manage things so that we're having the right discussions, or so that we're avoiding problems, right? And I guess this is almost even pre-agreement, right? Like, how do we get our heads around what we're doing? And of course, that leads to some of the other questions that are sort of all linked here. But a lot of people are asking, how do I keep an eye out for problems? How do we sort of spot them early and kind of nip them in the bud before they become a real problem, which is absolutely the right way to be thinking about these things, right? Like we get really clear, document it, but very much, as you said before, Joe, you don't just throw it in the bottom of the drawer and go, oh, great, that's all done now. You need to be managing things on an ongoing basis. And look, to that end, I'd be always advocating to people that, if it's one thing, it's communication, and I might sound like Captain Obvious here when I say stuff like that, but so often people fail to have the conversations they're meant to have, for various reasons. They're a bit awkward or a bit afraid of it, or don't want to, wreck the harmonious buzz that we've got in this new venture. But really that conversation up front, is so critical. And in a lot of ways, I think people feel vulnerable, and that's why they don't want to have that conversation. But it's actually okay to sit down with people and say, hey, this is where I'm thinking, what I'd like to get out of all of this. And this would be a good day for me. This would be a good life for me. This is, these sort of things wouldn't really sit well with me. How do you feel about this? Those kind of conversations, once again, may seem a little obvious, but they just don't happen enough. And much better that you're having a little bit of a discussion about things early on than having a legal battle down the track. So I think that this discussion point, and even if you had that up front, right, life changes. So keep that channel open. And if you get a sense that your business partner's kind of moving slightly in a different direction, or just things don't quite feel right, well, the time to have that conversation is now, before that goes from a little crack in the wallpaper to the Grand Canyon, right? So communication and talking about it, and look, fundamentally, and I'll finish on this point and hand over, but it's, if you're not 100% comfortable doing that yourself, get somebody in to help you. Have an external person who's impartial, somebody who can run you through a bit of a process. This stuff is not new, right? There are well-beaten paths on how to handle these problems, and more so, I guess, try to set things up properly so you don't have problems.
That is such a good point, Simon. I think the point that you made about issues not just appearing out of the blue is spot on. Usually it's something that is festering over a period of time. And it's just about, it's jumping on that early. I love your idea of this, this communication piece. And there should be some regularity around it, shouldn't there? We have annual planning days for businesses. I think this is something that should go in as one of that annual planning thought processes. And I'm totally with you in the idea that people aren't necessarily good at facilitating this sort of question and answer, thing themselves. And sometimes it's a bit like you can't see the wood for the trees, right? Tom actually has just commented, I think, super good point here, Tom. It can be having a third party involved can really help take away that emotion. And that's such a good point, because it's emotion often that drives issues. And actually that segues with one of the questions that I wanted to answer about what do I do? How do I fix a partnership issue where we don't have this in place at the moment? And as we saw, a really large number of our respondents, 80% of people, you who are there listening to us right now, either don't have a shareholders agreement or haven't discussed it in the last 2 years. So what if something comes up, you haven't got that covered off in your shareholders agreement? We see this day in, day out as well. We've got an example of this sitting on our desk right at the moment. A business owner set up, and Andrew set up an IT business. And in setting up this business, at the time, he thought, there wasn't, there may not be much value to it. He didn't have money to pay people to help him set up the business. So he gave equity instead. So small amounts of equity, minority equity. And you probably already know the end of this story before I get there, right? Because it's a common scenario. So anyway, the business is 5 years old. It's just been an amazing business, but it's grown incredibly. And the people that he gave equity to right in the beginning have done zip all for this period of time in the business. The problem is he's now looking at the concept of exit, and it's really tricky because he is now going to be hamstrung by them in an exit because he doesn't have a shareholders agreement with a drag along clause. So we were able to resolve that situation by going in and working out what is it that these minority shareholders might want. Where's the win for them in having a shareholders agreement in place? And the win for them is having some sort of clarity about how they exit if they want to exit. And so use that as a way that we could get a shareholders agreement in place, which had a win for the minority shareholders, but of course it had a really big win for our client because in that we were able to get a drag along clause in.
And just to that point quickly, Joe, while I think of it, like a lot of people on this call might be thinking about equity as an incentive motivator, right?
Yeah.
And look, it's also it's been around a long time as a strategy, a proven kind of methodology, but it doesn't work for everybody as well. And there are actually lots of alternatives to that sort of stuff, which I won't go into that in detail today, but don't feel like giving away equity is the only option for making sure you've got great people in the team who are motivated, hungry, and heading in the same direction.
I think, if I think about what you guys have both said, I keep coming back to what do we need to look for as advisors? And I actually think we need to look for complacency. I really think we need to look for complacency in business owners. I had a client recently who we were doing buy-sell insurance for, and we went through the shareholders agreement. There was basically a transition of shares between a director who was bought out of the business about 4 directors ago. And that their current shareholders agreement, because it hadn't been looked at, basically stated that if this shareholder over here was to pass away, the shareholder who's already been bought out of the business will actually receive the shares because they just hadn't got around to updating things. And I just think, I think if anyone is listening here thinking about what should my one takeout be, it should be get advice. Don't be complacent, ask the question, because there are so many ways that you can obviously attack all of this. My question that I was going to talk through was more around business partners being critical to driving revenue in the company and how do we operate if they get sick or injured. And I think I have spoken to this to some extent, but I keep coming back to what is that key person's role in the business. And if they are key to your business generating revenue, well, often they're not replaceable. And often what you're going to need is to find someone to replace that person. And dependent on what your business looks like, it's not often easy to find the right person. It could be that you need to write a check and essentially provide someone with equity or a sign-on bonus to get them in. Where does that money come from? How do you keep paying for staff? And I do keep coming back to key person insurance being a really, really critical element of this. I won't go back over examples that we've already spoken about, but there was another question around how you can structure your buy-sell insurance. And I think this is actually quite an interesting one, because a lot of people do speak to me about, can super pay for it? Can the business pay for it? Who should be paying for the insurance? Should it be cross-owned? Should Simon own a policy on my life and I own a policy on Simon's life? And look, that again is going to depend on the structure of your business. And I, as an advisor, would sit down with your accountant and we would build that together. But in my view, the cleanest structure is actually self-ownership of these policies. That Simon owns a policy on his life, he pays for the premium, the money goes direct to his estate. I own a policy on my life. That policy is paid directly to my estate, and that transaction is actually tax-free. That transaction's tax-free if it's self-owned. There is going to be, and we won't go into market substitution laws and all of that. The taxman will get you at some stage in some form. But what's really important to note for people that maybe have old insurance benefits that have been in place for a long time, there used to be a train of thought that the business should own the policy on a buy-sell, or it should be cross-owned. And what you need to understand is that involves a transaction which is going to incur capital gains tax. So if Simon owns a policy on my life and I pass away, Simon is receiving the insurance money and effectively buying the shares off my wife, which is going to incur capital gains tax. So I think it's really important.
Motive, right?
Yeah, it's also called a motive. So I think it's really important that, to answer that question, that you are getting advice around how is that insurance structured. If you do have insurance, is it structured effectively? And, again, is your accountant happy with how it's structured? Because they need to make it all work if the rubber hits the road.
It's a good point.
Sorry, you go, Simon.
Sorry, Joe. You mentioned accountants there. Like, I think we've got a lot of advisors, people in professional services here on the call as well. And so, I think for you, if you look after clients, you provide advice, you're an accountant, a lawyer, or whatever, right? If you deal with people every day, just circling back on this, what to look for, right? And I loved your point, Nick, about complacency. The other one is, I think, just keeping an eye out for those little niggles, right? Like I've had a client, numerous clients actually, that have come to me saying, I'm over it, I want to get out. Can you sell my business for me, right? Can you do a valuation? Tell us what it's worth. We're thinking of selling. But after we've actually gone through a bit of a process with them, you actually discover that it's not so much they actually want to get out. There's just some problems within their business that they're not sure how to fix. And invariably, I've got to say, as a general rule, every business problem is generally a personal or people problem, right? Like, business is a people function, right? So it's, generally speaking, and I'm not saying it's a bad person or whatever, it's just for some reason, something, business, some sort of relationship's not working. So understanding what's actually sitting behind some of these comments as an advisor and being able to probe a little bit deeper and say, hey, you know what? It sounds like maybe there's a few things here. And if you're not comfortable having that discussion with your client, recommending, hey, listen, maybe you should get somebody kind of external, impartial, who can just give context. And it's not saying go and spend a lot of money on stuff either. Sometimes it's just a little bit of perspective, because all of my clients, and I will always tell them, you actually have the answers in here. It's just about asking the right questions to get the information out in the right way to, do something useful with it.
And I think it's important that as advisors, we're working with their other advisors. I think often, if you're an insurance advisor and someone comes to you for buy-sell insurance, you stay in your lane, you do your piece. But what I really think is important is that we get in contact with the accountant, we get in contact with the lawyer, and we actually all work together to make sure the client gets the right outcome. We all need to be rowing in the same direction. So I think it's really important that when we have a client that needs this, we all need to be in the same room, and we all need to be making sure that the insurance is structured appropriately for the accountant to get the best outcome, and that the legal agreement talks to the insurance. And if something happens, well, that money's doing what the accountant needs it to do. Like, we all need to be working together. And I think often where we find issues is that you've had three separate advisors who haven't actually worked together, providing advice without taking each other's advice into consideration, and it becomes a mess.
Yeah, that's such a good point. That's such a good point, Nick. I absolutely agree in the power of us, or being able to provide this sort of integrated advisory model where we've got the legals and the accounts and the exit planning and succession planning, and the insurance all working in together and all singing from the same hymn book. And it's such a better result for clients at the end of the day.
I'll give you a horror story there, Joe. Yeah.
Oh, we love the horror stories, Simon, don't we?
The good, the bad, and the ugly, right? Because if you don't do that, if you're not all on the same page, right? And like yourself, I mean, we've all seen some pretty full-on stuff out there. But we had a transaction going one day. We were selling a business. There were two business partners. They hated each other with a passion. And so, it's actually quite hard working with people who are like that. But literally, we got to the end and we had an offer. It was over a 4 multiple. It was industry. It was amazing. And simply brilliant offer. But even during this little process, their relationship had deteriorated so much further that we had one owner turn around to say to us, I'm not accepting the offer because I would rather burn this place to the ground than see that person get a single dollar out of this business. He needs this more than I do, and I don't really care. I'd rather burn the place down. And we sat there and went, oh my goodness, that's just an example of just how nasty things can get if you just don't have the conversations and talk about this stuff up front.
Yeah, it's such
Absolutely
a good point.
horrendous. Yeah.
And I just want to I'm going to throw in something in the chat panel here. You were talking earlier, Simon, about this discussion when business owners might be thinking about exit, but maybe not, they're not sure. And as you dig, you find some other things out in terms of what they might actually be thinking, or it can happen the reverse way. But we talked a lot about this in a podcast, and I've just thrown up that podcast episode because if you're interested, Simon and I talk quite a bit about that topic. So just thought I'd throw that in there.
Yeah, look, and I reckon, honestly, if I can, I'm sort of cognizant of time here, so maybe we've got a little time for a couple more quick questions, but, if I can give one point that I would hope everyone would take away from certainly from my perspective, my professional sort of perspective is, none of us are born to do business, right? We're actually born to live our life. So your business should simply be a vehicle for helping deliver the life you want. So, get clear on what you want over here, right? Because if you don't make decisions around the kind of life you want, fundamentally life just makes decisions for you, and often you end up in the wrong place. So going through a bit of a process, getting clear on what's important to you as an individual, also what's important to your business partner or partners as individuals, and then collectively, how do you bring those together into a shared vision? Because even like any business strategy, right? It's basically it's 1% vision and 99% alignment. And unless you go through something to get that alignment, it often just goes in directions you don't expect.
Such a good point. I absolutely love that, Simon. And I guess we have time for a couple of, I'm just going to really quickly run through a couple of questions here. How effective are non-compete clauses post-exit? Can be very effective, but they need to be set up right because there's certainly some traps there. I thought it might be interesting to point Nick to a comment that we've had from one of our attendees who talked about where they have actually had an issue where they were diagnosed with cancer and were unable to work for several months and didn't realize that they had trauma cover. So isn't that fascinating? I've heard a couple of stories of people forgetting they've had cover and then when it came to the point of needing it, them suddenly remembering that. So,
you'd be amazed. And this comes back to people not knowing what they're covered for. Really early on in my career, years and years ago, I had this beautiful client. He's actually subsequently passed away, but when I sat down with him looking at his insurance, I always talk about, we always get medical information because we need to understand because the insurance companies will assess you medically. So I need to understand if we're going to hit any brick walls. And in that, I said, his name was Robert, you had a brain tumor, Robert, about 9 years ago, and you've got this trauma policy. Did you claim on that? And he said, what's trauma? And he actually told me that his advisor visited him in the hospital when he was unwell. And I'm sitting there going, what how did you not claim upon this? And you know what? It was a CommInsure benefit, and CommInsure, to their credit, paid the benefit and refunded him 9 years worth of premium that he shouldn't have been paying. But I've had that, I would say, 4 or 5 times where clients have had policies. I had it last year with a client who received a $650,000 trauma payout for heart surgery that they had, that they actually rang me because their premiums were too expensive, wanting to cancel the policies. And we just got talking, and it was actually a bit of a fluke because my dad had had the same surgery like 2 weeks earlier, and we got talking about it. And he was like, "Oh yeah, I had that about a year and a half ago." And it made me sit there and go, "What did you claim on your trauma?" So again, it comes down to probably 2 things. Find an advisor who's actually going to work with you proactively. And when these things happen, you need to be having these conversations with your advisors. If it involves insurance, pick up the phone, and whether that's, your current advisor, whether you want to call me, say to me, "Hey, this is what's happened. Is this claimable?" It's a really quick and easy conversation to have. But yeah, no, I read that and that was really interesting. And it's great that it sounds like the policy did pay out.
Great. Well, are there any last minute questions for anyone? Very quickly, there's some questions about conflict between shareholders agreements and wills and what takes priority. You have to understand that shareholders agreements are generally between different parties. So you and another party, and so you have to be really careful about conflicts there, because your contractual agreements with another party may override what you want to do personally with your estate. So you need that all singing from the same hymn book. We've had comments about the importance of estate planning, with shareholders agreements working together. And I think that's absolutely a great point. Are there any other last minute, very quick questions that either of you want to quickly turn to, Simon or Nick? Or
Sorry,
any other last minute questions from
No,
our attendees as well?
I think I've said everything I need to say. I think we've had enough death and disablement for one day.
Well, I did like your point before, Nick. I think if you go through something traumatic in life, whether it is, accident or death or something like that to you or somebody you love, it's not the time to, be scrambling around and trying to work out what's what. And I think that's probably the benefit of having, well, frankly, someone like yourself, who I could just, and it might sound like a gratuitous plug here, so I apologize, but Nick looks after my insurance, so I've been through his experience. But if something happens to me or my wife, we pick up the phone and go, "Nick, this has happened, and help, thank you, hang up, it's being taken care of," right? Like, because I'm not going to be in the state to want to, have to deal with technicalities and things like that. So,
and you don't want to talk to insurance companies directly because you'll sit on hold for about 45 minutes. So yeah, come, we'll do that for you.
Yeah, totally.
Well, how about we maybe all just share some of our last minute couple of tips to leave the audience with. If we have not answered your question, you should have an email in your inbox right now. Actually, it will be there right now. If you want to ask any of us questions, we'd love to answer those questions for you. If we haven't answered your question, then just pop us a note and we'll get back to you with an answer. And I guess for me, just signing off for everyone, my top tips are actually jumping on something Simon said earlier, which is get this stuff in place while you're in agreement. And if you can't, there's still ways that we can deal with it, but it's much harder. So it's much easier if you can do it while you're still in agreement. Use shareholders agreements to be the element that forces you to ask those questions that you may not otherwise ask. Make sure you get it in place and make sure you get it reviewed. I think that's if you meet those elements, then you'll be able to deal with decision-making issues, exit, and all of those things that we've talked about today, a lot more proactively, avoiding the issues occurring in the first place and giving you some sort of parameter to deal with these things as they pop up along the way. And that's my point, I think.
Yeah, and to dovetail into that, Joe, I think, I think a lot of the times people don't have these discussions is because they feel uncomfortable about personal conflict. And I think too, if you can step back from that a little bit with business partners and say, "Hey, listen, I'm actually taking off my shareholders hat here and I'm taking off my employee hat. As a director, as both directors, we both have a responsibility to make decisions in the best interest of this company. And as a director, man, it's important for me to ask these questions, for us to talk about this stuff, right? Because otherwise we're doing a disservice to the company, and then in effect, potentially the employees, our customers. Like it's not necessarily me asking you, it's, hey, we both have a responsibility to discuss it. It's just the right thing to do.
And I guess it's about, don't just set and forget as well, right?
Totally.
And I think one of your points earlier, I think it was you, Simon, engage a third party. You spend your life building this business. Sometimes when you build it brick by brick, you can't actually see what you've built. You need someone from the outside to look within and go, they can actually see what you built. And I think it's a great idea to get a third party that's not emotionally attached, that can sit to the side and question you. So, and from an insurance perspective, know what you're covered for. Just know what you're paying for.
Someone to put the match out before they burn the place to the ground. So.
I just have one last point. And as you're leaving now, you're going to get a survey. Please fill in that survey. We really want to know what you thought about the information today, what you want to hear more about, and all of those sorts of things. So we're really interested in your thoughts. So please, just as a request from us to you, please fill in that survey. Really quickly, someone has made a comment about non-voting shares. Yes, can be very clever. There can be risks with that, though, in relation to what the way that they can impact concessions at sale when you're creating different types of shares. So be super careful about how you're setting things like that up. But guys, I just want to say an absolutely massive thank you to both of you for coming on to the webinar today. I hope you, our attendees, found it useful. We'd love to speak to you if you're a business owner and this has struck a chord with you, or indeed if you're a business advisor and you're looking at ways that you can help best protect and work with your clients as they're considering these things in their business. So I just want to say a massive thank you to all of you for coming along today. Any parting words, Simon or Nick, before we wrap it? Brilliant. Wonderful. Okay, thanks guys, and have a fabulous rest of your day. Bye.